Alright, having done all our research in the Jupyter Notebook or Quantopian research platform, we now move on to the Backtester or the IDE. And so the code here is very similar to the backtest that we did earlier, but I'm still going to walk through it. So a couple of things that we need is that we need to import pipeline and also the pipeline output in a Hedge pipeline as well to run it in this IDE backtester platform. The other thing that we need is import the Q1500 trading universe as well as Syntax, because we're gonna make use of the Syntax API, in particular sentiment, to conduct our backtest. The initialize, which is run at the start of the algorithm, we will store two functions here to run on a daily basis. The first one is run our myBalance function on a daily basis 1 hour after market open. The second one is to run the so-called recording of the variables at the end of every day when market close. For now, we just set the commission as being 0 because we really want to see if there's any alpha that is embedded in the so-called algo itself. Other things being that the reason for setting the commission being 0 is that it depends on your so-called portfolio size, whether you are institutional trader or your retail trader. It does make a difference in terms of how much in terms of your commission get charged. Once you actually run this backtest, if you're happy with it, Quantopian does allow you to actually port it straight through to interactive brokers to trade. Interactive brokers charge fees is extremely low. I encourage you to actually have a look at it. They do actually have a volume based, but typically it's around 1 cent. Okay, so the other line that we have here is the attach pipeline, which I'm going to go into now. Basically, what are you attaching? You are attaching the make pipeline function here. The make pipeline function should look very familiar to you, being that we've done this in the research platform itself. The first thing is that we want to actually store the sentiment signal into the sentiment factor variable, and the next thing is that we want to actually set our universe. There are two things that we set here. One is that we are just going to focus on Q1500 US only. That's our universe. And the other thing is that we're just looking at the sentiment factor that is it has to be not 0, meaning if it has not a number or 0, we just basically ignore those days and there's basically no signal and there's no trade at all. We split them into quantiles for recording purpose. We won't be using that. The long short is set based on the sentiment factor, whether it is less than -2 or greater than 4. If you do recall Syntax, when we actually conduct our so-called analysis in the research platform, the distribution of it looks like this. So over 6 is over here. So basically it ranges from -3 to 6. What we have set here is that it's -2 and greater than 4. -2 being this so-called bin here and greater than 4 being this bin here. And we set the screen for the pipeline being the universe, which is this portion that we set here, and then return the pipeline. Other so-called function that we have set to run before trading start, meaning every time that at the beginning of the day before market open, we'll run the pipeline once more and then store all of the so-called stocks into the context itself. Context is a universe or global variable whereby every so-called function can access it. And my rebalance, as mentioned before, runs on a daily basis. At the beginning of the day, we set it 1 hour after market open. So I'm just going to briefly touch on here because we already talked about earlier. Our long securities is from the context itself that is run via pipeline earlier at the beginning of the day. It selects the stocks to go long on, basically with the sentiment value from Syntax that's greater than 4. And out of these lists of long securities based on the length we provide, we just basically take 1 divided by the length, meaning however many stocks there. If there's 10, we allocate 10% to each one. If it's 20, basically 1 divided by 20. So that's the weightage that we set for each long stocks. Likewise, we do the same with the short securities. The list of securities come via context, which is also from the pipeline that we run with the so-called sentiment value that's less than 2, or less than -2, I should say. Again, the weight is set on evenly distributed, evenly weighted, so -1 divided by however many securities in there. So we open and run our open our long position and open our short position. Anything that is not in the list that comes through on a daily basis from pipeline, we close that off. That's really what this procedure here, or this loop here, is for. Just loop through every single stocks. If it's not on the list, just set the percentage to 0. Okay, and the last function here is recording the variables. And basically we record how many longs and shorts that we have and the actual leverage that we apply to the so-called whole long short algorithm itself. So let me just run this for a short time. I just want to make sure that there's no errors in there before we switch over to the full back test. So let's just let this run for a couple of minutes. Okay, look, all right, so it looks to work okay, so I'm just going to cancel this and run the full back test. The slight variation between this and also the earlier side signal algo is that I did not include any event investor, meaning all of the earnings are not before and after earnings event. In the side signal, I use 2 days before, don't trade, 2 days after, do not trade. And if also the company is actually a merger or acquisition target, do not trade those. Notice that those futures are not included in here. So it's not really a direct comparison between the two providers. This is just a difference, so-called in terms of how we set up the algorithm. This is just to illustrate the syntax pure so-called signal itself. I encourage you to play around with it. There are a lot more so-called innovation that can be done in this space. For now, I'm just going to run the full back test. I'm going to mute the sound, but I'm going to accelerate the so-called back test a little later in the video itself so that you don't have to watch through the whole thing. Okay, let's look at 2014 to 2016. Okay, as you can see, the so-called backtester has finished running. We're going to move on to the so-called Pifolio now, just to actually have a look through the so-called performance of the so-called the algo itself. First thing is that we do want to copy these backtest results. A couple of things I do want you to take note of during this period that we ran the backtest was from 2014 December until 2016. So roughly we have a year and 2 months of data here from 2014 to 2015. So a year, about 3 months, sorry. So if you look at this, S&P 500 basically was is actually down 4%. Our algo was up 5% with a volatility of roughly 5%, and the drawdown is about 6% for the whole period. So the algo has done really well, although the chart doesn't show that it actually is so, but it's still very, very good because it has a very low beta, basically not correlated to the market at all. So that's the beauty of this kind of algo. The long short is that you are not susceptible to the market big downturn. Notice this sharp drop for this period here from it doesn't show the timing here. I can't see the date. Oh yeah, August 18th until August 26th. The market went from up 28%, up 2.8% to down. So basically, it dropped 10% over a period of 3 to 4 days, whereby the algo just basically stay even. So that's really one of the attractiveness, and that's the strength of a long short algorithm, is that you are market neutral, and that's a really attractive features. And basically, because it's uncorrelated to market, and if you go back to the Finance 101, what you really want is that your algo or your so-called portfolio is basically has a characteristic that is not correlated to the market. That's the first thing. Second thing is that it provide a diversification, and diversification is really related to correlation. If your portfolio is have a correlation, meaning a beta of around 0 or plus or minus 0.3, it is an attractive algorithm, as long as it make money, of course.